I want you to imagine just for a second that you are sitting across this, like, massive mahogany table from the absolute most successful financial minds in the entire world.
Oh, that's quite a room to be in.
Right. I mean, I'm talking about the kind of people who literally move global markets with a whisper.
The absolute titans of industry.
Exactly. The ones who have, accumulated wealth and success on a scale that almost breaks the human brain's capacity to even comprehend it.
Yeah, the numbers get a little abstract at that level.
They really do. So you lean in, you've got your pen in hand, and you are waiting for the secret.
You want the magic bullet.
Right. You are expecting a highly guarded algorithm, right? Or maybe a hidden mathematical formula locked in a vault somewhere.
Or some piece of insider knowledge that the rest of us mere mortals simply, do not have access to.
Exactly. But what if I told you that the most shocking thing you discover about them is that their ultimate secret weapon is not a mathematical formula at all?
That's the kicker, isn't it?
It really is. It's something entirely different. It's something profoundly human.
It really is the ultimate subversion of expectations, I think. We walk into this world of high finance expecting pure, cold mathematics.
Right, like massive mainframes and quantitative supremacy.
Exactly. And instead, when we actually sit down with these titans, we are confronted with what is essentially, well, a masterclass in human psychology and behavioral finance.
Okay, let's unpack this, because that is exactly our mission today.
Right.
We are taking a deep dive into a text that has fundamentally shifted how people understand success in the financial markets.
And frankly, success in high-pressure environments generally.
Yeah, absolutely. So we're looking at Jack D. Schwager's profoundly influential book, Market Wizards.
It's a classic for a reason.
It really is. Now, for those who might not be, intimately familiar with the background, Schwager essentially went on this multi-year quest.
A massive undertaking.
Yeah, he tracked down the most elite traders on the planet. I mean, people operating across different asset classes, from equities to commodities to foreign exchange.
And he interviewed them. He just sat down and asked, essentially, how are you doing this?
Right, like what is the secret sauce?
And what makes Schwager's interviews such a vital resource is his methodology. Because he didn't just interview one type of trader who caught a lucky break during a raging bull market.
Yeah, anyone can look like a genius when the line just goes up.
Exactly. He specifically went after a wide, diverse array of market participants who have demonstrated sustained astronomical success over long periods.
We're talking people who endured various market cycles, right? Like crashes and manias.
Right. And the brilliance of what he compiled lies in the ability to synthesize this incredibly diverse information and spot the underlying behavioral patterns among absolute outliers.
So it's not just looking at what they trade.
No, the true value here isn't just in knowing what these traders buy or sell. It's not about copying their daily routine or trying to front-run their specific asset class.
Right, because if we just try to copy their trades, we'd be missing the entire point. The market would have already moved.
Exactly. The value is in understanding why their specific cultivated mindsets yield such immense success.
We are here to extract the psychological frameworks. We want to decode the exact mindset required to navigate extreme uncertainty.
Which is applicable far beyond Wall Street.
Oh, 100%. Because while the subject matter here is financial markets, the insights we are pulling from Schwager's work are overwhelmingly applicable to anyone trying to operate at a high level.
Precisely. We are exploring the architecture of a winning mind, which, as it turns out, is built on a foundation of rigorous self-awareness.
I love that phrase, the architecture of a winning mind. But before we can even begin to construct that architecture, talk about the specific rules of success laid out in these interviews, we have to clear the lot.
We have to do some demolition first.
Right. We have to shatter the biggest illusion that exists regarding financial triumph.
You are referring to the myth of the one right way.
Exactly. Because if you read through these interviews, the first major revelation is that there is absolutely no single strategy for success.
None at all.
Schwager explicitly states that each trader he interviewed had developed their own completely unique style. And honestly, that is so counterintuitive to how we are conditioned to think about success.
It really is. We live in a world that is completely obsessed with hacks.
Yes, we want the 10-step blueprint. We constantly look for gurus on social media to just, hand us the right answer.
The perfect morning routine, the flawless trading setup.
Exactly. But here we have the absolute pinnacle of financial success telling us, hey, there is no single path, my path probably won't work for you.
What's fascinating here is the psychological implication of that revelation, especially when you look at the mechanics of trading.
How so?
Well, in a world desperate for universal formulas, the most successful people on the planet actively reject the idea of a singular path.
Because they know it's a trap.
Right. They understand that a copy-paste approach to the markets is practically guaranteed to fail, and the reason why it fails is crucial to understand.
Okay, lay it on me.
A strategy must fundamentally align with the psychological profile, the processing speed, and the risk tolerance of the individual executing it. You simply cannot borrow someone else's conviction.
Okay, I want to push back on that a little bit, or at least explore deeper,
Yeah.
because if there is no single strategy, why do we see massive industries built around selling these, like, black box trading systems?
That is a great question.
Right. People pay thousands of dollars for proprietary algorithms that tell them exactly when to buy and sell. Why wouldn't that work?
Because of the human element.
But if a system is mathematically profitable, shouldn't anyone be able to just flip the switch and let it run?
In theory, yes. In practice, no. And the interviews in Market Wizards illustrate exactly why.
Okay, give me an example.
Let's say I give you a mathematically proven, highly profitable trading system. But this system is a trend-following system. It operates on the premise of catching massive, multi-month trends.
Sounds great so far.
The caveat is that it only wins 30% of the time. The 30% of the time it wins massive amounts of money, far outweighing the 70% of the time it loses small amounts.
Wait, 30% win rate, that sounds painful.
It is psychologically excruciating. If you are a person who has a high need for validation, or a person who hates being wrong.
Which is most of us, to be honest.
Exactly. Or if you're a person who gets anxious watching small losses accumulate day after day, week after week, you will abandon that system.
Because you just can't stomach the losing streaks.
Right. You might hit a streak where the system loses 15 times in a row, which is statistically totally possible within a 30% win rate.
Oh, wow. 15 losses in a row would break me.
The math says, stay the course.
Mm.
Your brain, screaming in agony, says, turn this off immediately.
Right. You just pull the plug.
You will override the system right before the massive trend occurs. So you failed not because the system was broken, but because the system did not match your psychological tolerance for drawdown.
Okay, that makes perfect sense. It's less about the math being wrong and more about the human being unable to tolerate the specific flavor of the math.
I like that, the flavor of the math.
It makes me think about trading, or honestly any high-level performance, really, less like assembling a piece of IKEA furniture and more like tailoring a bespoke suit.
I think that captures the essence of it perfectly.
Think about it. With IKEA furniture, you get a universal instruction manual. It's a literal blueprint.
Right, tab A into slot B.
Yeah, you have an Allen wrench, you have steps A through Z.
Right.
It doesn't matter if you are tall, short, anxious, calm, impulsive, or deliberate.
If you follow the universal instructions, you get the exact same bookshelf as the guy next door.
Exactly, you can outsource the thinking. But a bespoke suit, that is a completely different, highly individualized process.
You have to account for the unique dimensions of the individual.
Right. You have to take exact measurements. How do they move? How do they stand? What is the slope of their shoulders?
Because if it doesn't fit, it doesn't work.
Exactly. If I take a bespoke suit, perfectly tailored for a world-class 6'5" athlete, and I try to wear it, it's going to look ridiculous on me.
It will completely restrict your movement.
Right. It only works if it fits the exact measurements of the person wearing it. And what Schwager's interviews are telling us is that a financial strategy operates on the exact same logic.
It has to fit your psychological measurements.
Yes.
And we see this dichotomy brilliantly illustrated in the book. You have traders like Ed Seykota, who is a pioneer in computerized trend following.
He's the algorithm guy, right?
Right. He relies heavily on algorithms. His strategy is entirely systematic. He doesn't want to guess what the market is going to do.
He just wants to follow the code.
Exactly.
Yeah.
He wants his computer to trigger a buy or sell order based on strict technical parameters. That fits his deeply analytical, systems-oriented mind.
Okay, so that's one extreme.
But then you have a trader like Paul Tudor Jones. He's a macro trader who operates with a highly contrarian, almost intuitive feel for market extremes.
Totally different vibe.
Entirely different. He is looking for exhaustion points in the market, relying on a mix of fundamental analysis, technicals, and an incredible sense of market psychology.
They are essentially playing entirely different games on the exact same field.
Exactly. If you forced Ed Seykota to trade based on Paul Tudor Jones's gut feelings about macroeconomics, he would likely freeze.
He'd hate it.
And if you forced Paul Tudor Jones to blindly follow a slow-moving algorithm without being able to express his read on market sentiment, he would be miserable and likely override the system.
So the strategy is a natural extension of their personality.
The listener really needs to internalize this. The wizards developed their own style.
Yeah, that word developed is doing a lot of heavy lifting there.
It implies a grueling process of trial, error, painful self-reflection, and eventual alignment.
It's not about finding the holy grail of trading systems out there in the world somewhere.
No, it's about finding the system that you specifically can execute flawlessly under pressure.
So, turning to you, the listener, think about how this applies beyond just the financial markets. How often are you looking for the one right way to tackle a complex problem?
Probably more often than we realize.
Right. How often are you searching for the universal IKEA instruction manual for your career trajectory, your leadership style, or your creative process?
When you really should be looking inward.
Exactly. Schwager's work strongly suggests that the real work, the hard work, is taking your own psychological measurements.
Are you comfortable with high volatility and quick decisions, or do you need deep research and slow, methodical execution?
You have to tailor your approach to fit you.
It is a profound shift in responsibility, honestly. It moves the burden of success from finding the right external guru to developing the right internal awareness.
Oh, wait, if everyone is wearing a completely different bespoke suit, right?
Yeah.
Like if Ed Seykota is using computers and Paul Tudor Jones is reading macro sentiment and someone else is trading entirely on news catalysts,
Yes.
what actually makes them all wizards? If there is no universal offensive strategy to make money, what is the common thread?
That is the pivotal question.
Because when these bespoke strategies inevitably fail, and we know no strategy works 100% of the time, how do they survive?
Well, if we strip away the specific asset classes and the specific entry signals, we find the core bedrock of their longevity.
It's a secret sauce.
What binds all of these incredibly different approaches together is their approach to defense.
The shield over the sword.
Exactly. The interviews reveal a universal, non-negotiable truth among elite traders. Risk management is exponentially more important than making profits.
Now, I have to stop you there. Because on its face, that sounds completely absurd.
I know it does.
Risk management is more important than making profits.
Mhm.
I mean, for people whose entire literal job title is trader or investor, whose success is measured strictly, entirely, 100% in monetary profit,
Right.
to say that managing risk matters more than making the money, it sounds totally backwards. Aren't these people famous because they take massive risks and make billions of dollars?
It seems contradictory until you analyze the deep context of the mathematical reality they operate in.
Okay, walk me through that.
Well, the general public assumes that successful traders are individuals who are obsessed with making money. They picture Gordon Gekko, wild bets, and massive leverage.
Wall Street movie stuff.
Exactly. But Schwager's interviews prove the exact opposite. The most successful traders in the world are primarily obsessed with not losing money.
Not losing money.
Making money is actually the secondary byproduct of their primary directive, which is survival.
Okay, explain the math behind that, because I think people hear risk management and they just think it means being careful. But it's way more mechanical than that, isn't it?
It is ruthlessly mathematical. Let's break down the asymmetry of drawdown, because it is the absolute foundation of their entire worldview.
All right, let's do the math.
If you have a portfolio of $100,000 and you take a massive risk and lose 50% of your capital, you are down to $50,000.
Right. Painful, but you just need to make 50% back to get even.
Right. That is the cognitive trap. You do not need a 50% gain to get back to where you started.
Wait, really?
Think about it. If you make a 50% return on your remaining $50,000, you only gain $25,000.
Oh, right, because the base is smaller.
Exactly. You are still at $75,000. To get back to your original $100,000 from a $50,000 balance, you need a 100% return.
You need to double your money just to break even.
Yes.
Wow, okay, that is brutal. The hole gets exponentially steeper the deeper you dig it.
Exactly. If you lose 75% of your capital, you need a 300% gain just to get back to zero.
That's practically impossible.
Which is why this mathematical asymmetry is the reason elite traders are hyper-aware of risk. Preventing ruin is the absolute non-negotiable prerequisite to generating wealth.
You cannot compound your capital if your capital is gone.
Therefore, they treat risk management not as a defensive afterthought, but as the core engine of their longevity.
But wait, I want to play devil's advocate here for a second.
Go for it.
If you are that terrified of the asymmetry of loss, how do you ever pull the trigger? You can't manage risk if you aren't making any money.
True.
If you are so obsessed with not losing, wouldn't you just keep your money in a savings account? How do they actually balance taking the leap with protecting the downside?
That is where the concept of position sizing and asymmetric risk to reward comes into play. They aren't avoiding risk, they are highly engineering it.
Engineered risk. I like that.
An amateur trader might find a stock they like and put 50% of their entire net worth into that single trade, hoping for a home run.
Yeah, the classic YOLO trade.
A market wizard would never ever do that. A professional might only risk 1% or 2% of their total capital on any single trade idea.
Wait, so if they have $1 million portfolio, they are only risking $10,000 to $20,000 on a given trade. That seems so small for a titan of finance.
It seems small, but it guarantees survival.
How so?
If you only risk 1% of your capital, you would have to be wrong 100 consecutive times to go broke. It provides an incredible psychological safety net.
That makes a lot of sense. You can sleep at night.
Furthermore, they pair this small position size with asymmetric risk-to-reward ratios. They might structure a trade where they risk $10,000, but the realistic upside target, if they are right, is $50,000 or $100,000.
They are risking 1 to make 5.
Precisely.
Ah, okay. So even if they are wrong more often than they are right, the math still works in their favor.
Exactly.
If I risk $1 to make $5, I could be wrong on 3 trades, lose $3, but be right on the 4th trade, make $5, and still be net profitable by $2.
They focus entirely on their downside exposure before they even enter the trade. The amateur focuses on how much money they can make, envisioning the new car they will buy.
While the professional focuses on exactly where their exit door is.
Right. They use mechanisms like stop-loss orders, which are pre-programmed orders, to automatically sell a position if it drops to a certain price, to ensure that a small loss never turns into a catastrophic, portfolio-destroying loss.
So the stop loss is literally a mechanical safety net. It takes the decision-making out of your hands when things go bad.
Exactly.
It reminds me of rock climbing, actually.
How so?
Well, you don't just free solo up a cliff hoping you don't fall, unless you're crazy. You place anchors in the rock every few feet.
Right, the carabiners and the ropes.
Yeah. So if you slip, you only fall 3 feet, not 300 feet. The anchor is the stop loss. It limits the drawdown. It ensures you survive to climb another day.
That is an excellent way to visualize it. This obsession with capital preservation is what allows them to stay in the game long enough to let their winning strategies actually play out.
Okay, so we've established that you need a bespoke strategy that fits your personality. And you need rigid mathematical risk management, those anchors in the rock face, to ensure you don't blow up your account.
Yes.
That all makes perfect logical sense. But knowing that risk management is paramount, mathematically understanding that you have to protect your capital, I mean, the one thing.
It's the theory.
Right. Actually executing it when real money is on the line, when the screen is flashing red, when volatility is spiking and the financial news is screaming about a market crash.
That's the reality.
Yeah, that requires something much deeper than mathematical logic.
Now we are moving from the theoretical into the physiological. Because you are absolutely right. A plan is only as good as your ability to execute it under duress.
Which brings us to the inner game of trading. Discipline and emotional control.
the hardest part.
Honestly, it feels like the hardest part. You can teach someone the math of a 1% position size in an afternoon. But teaching someone not to panic, how do they do that?
If we look at the broader context of what the market actually is, it becomes clear why this is so incredibly difficult.
What is the market in this context?
The global financial market is essentially a giant real-time mirror. It reflects the collective human emotions of every single participant on Earth.
Wow, that's a heavy thought.
It is a pendulum swinging violently between fear, greed, panic, and euphoria. If you enter that arena without absolute emotional discipline, the market will exploit your psychological weaknesses.
Let's talk about those weaknesses, because I think a lot of people assume these elite traders are just like ice-cold sociopaths who don't feel emotion.
A common misconception.
But they are human beings. We are hardwired by millions of years of evolution to run away from pain and run toward pleasure.
Exactly.
And in the modern world, losing money is neurologically processed by the brain as acute physical pain. So you have these traders who have to essentially override their own biology.
That is exactly the battle. Strict risk control, the math we just talked about, completely falls apart without the bedrock of emotional discipline.
You can't just rely on the spreadsheet.
You can have the most brilliant risk management spreadsheet in the world. You can have your stop loss levels perfectly calculated. But if you panic, cancel the stop loss order, and ignore your rules when the position goes against you, the spreadsheet is entirely worthless.
Right. Here's where it gets really interesting. It makes me think about poker.
Oh, poker is a fantastic parallel.
In poker, there is a concept called going on tilt. You can be a mathematically brilliant poker player, you know all the probabilities, you play a hand perfectly, but you get hit with a bad beat.
Right, some amateur catches a lucky card on the river.
Yeah, and they take a huge chunk of your chips. Statistically, you played it right, but you still lost.
And how does the average player react to that?
They lose their minds. They get angry, they get frustrated, they want revenge on the player who took their money. They go on tilt.
And then the math goes out the window.
Completely. They
Right.
start playing terrible hands, abandoning all their mathematical discipline, just trying to force the money back. And within an hour, they've blown their entire stack.
The math didn't fail them, their emotional regulation failed them.
Exactly.
That poker analogy is incredibly apt for the financial markets. The market will frequently hand you a bad beat.
Because it's probabilistic.
Right. You can do all the research, build the perfect thesis, execute the trade with the correct position size, and then an unexpected geopolitical event occurs.
Or a central bank makes a surprise announcement.
And your position is just wiped out.
So how did the market wizards avoid going on tilt? Do they just repress it?
No, repression doesn't work. It eventually boils over. What Schwager's interviews reveal is that they actively build systems to manage their psychology.
Like what kind of systems?
They create circuit breakers for their own minds. For instance, many of these traders talk about the importance of stepping completely away from the screens.
Physically leaving the room.
If they take a bad loss or series of losses, they don't sit there staring at the flashing quotes trying to exact revenge on the market.
They don't try to win it back immediately.
Right. They recognize the physiological symptoms of going on tilt, the elevated heart rate, the narrowing of focus, the anger, and they physically remove themselves from the environment. They go for a run, they hit the gym, they meditate.
They break the state.
Precisely. They understand that when they are highly emotional, their IQ practically drops. They are no longer processing probabilistic information. They are just reacting to stimuli.
Like an animal in a trap.
Furthermore, they rely on the absolute rigidity of their trading rules. They don't make decisions in the heat of the moment.
When do they make them?
The decision of where to exit a losing trade was made hours or days before the trade was ever executed, when they were in a calm, rational state of mind.
That is such a crucial distinction.
Mm.
Make the rules when you are calm so you don't have to make decisions when you are terrified.
It's the separation between feeling an emotion and acting on it.
It's like a captain steering a ship through a hurricane. The market is the hurricane. You cannot control it. The only thing you can control is the ship and your own reactions.
The discipline to stick to your strategy.
Right. It's not that the wizards don't feel the fear or the frustration. It's that they don't let the fear touch the steering wheel. They have pre-programmed the autopilot, the stop losses, the rules to take over when the turbulence hits.
And this emotional control is most severely tested in one specific unavoidable scenario. A scenario that every single trader, no matter how skilled, must face constantly.
Which is when they are dead wrong.
Yes.
Which leads us perfectly into the hardest pill to swallow. Let's talk about the alchemy of failure.
It's unavoidable.
Because here is the brutal truth of these interviews. Even with your bespoke strategy, perfectly tailored to your psychology, even with the strictest, most mathematically sound risk management anchors in place,
Yes.
even with the emotional control to avoid going on tilt, you will still lose. How the market wizards process that inevitable failure is, in my opinion, their true superpower.
It is the psychological crucible. Every trader loses. Even the greatest traders in the world might only have a win rate of 40 to 50%.
They are wrong half the time.
They are. Therefore, how they internalize being wrong dictates their ultimate survival.
But the conventional wisdom is so simple, right? Learn from your mistakes. We've heard that on every motivational poster since kindergarten.
Sure, it sounds easy.
But doing it when hundreds of thousands or millions of dollars are evaporating, I have to imagine that feels profoundly different.
It requires a fundamental rewiring of how a person perceives failure. Let's analyze how the average person, outside of elite performance, views a loss or a failure.
Okay.
For most people, a financial loss or a failure in any competitive arena is viewed as a personal indictment.
Wow.
It's deeply internalized.
Oh,
The
absolutely.
thought process is entirely tied to ego. I lost money, therefore my idea was bad, therefore I am foolish, therefore I am a failure. The ego is inextricably tied to the outcome of the event.
We want to be right so badly. We attach our identity to our opinions.
Exactly.
If I tell everyone at the dinner table that a certain stock is going to double and then it drops 50%, I don't just feel the financial pain, I feel the social humiliation. My ego is bruised.
And that ego bruise is the primary mechanism of financial ruin in the markets.
Because we refuse to admit we were wrong.
Because if you view a loss as an indictment of your intelligence, you will do anything to avoid confirming that loss.
Oh.
You will hold on to a losing position, watching it drop lower and lower, praying it turns around just so you don't have to sell it and officially admit you were wrong.
You essentially let the ship sink because you don't want to admit you charted the wrong course.
Precisely.
It's only a paper loss until I sell.
Right.
That's the classic rationalization.
It is a fatal rationalization. But the elite traders interviewed by Schwager operate on a completely different psychological operating system.
How do they do it?
They have actively decoupled their self-worth from the outcome of any single trade. To a wizard, a loss is not a personal failure. It is viewed neutrally, simply as an inevitable business expense.
A business expense, like buying inventory.
Precisely. Just as a restaurant owner must buy massive amounts of ingredients to serve meals, knowing full well that some of those ingredients will spoil and be thrown away.
Right.
A trader must incur losses to find the winning trades. It is simply the cost of doing business. You cannot run a restaurant without some food waste, and you cannot run a trading portfolio without some losing positions.
Love that. When a restaurant throws away a bruised tomato, the chef doesn't sit in the kitchen crying about what a failure he is.
No, of course not.
He just throws it in the compost and moves on to the next dish. It's just a tomato.
And furthermore, they view these losses as highly valuable data points. For instance, Bruce Kovner, one of the legendary macro traders interviewed in the book, has talked about how he views every trade simply as a hypothesis.
A hypothesis. So he's treating it like the scientific method.
Exactly. He looks at the global market, gathers the data, and says, my hypothesis is that interest rates will rise, which will cause this currency to fall.
Okay.
He puts on the trade. That trade is the experiment. If the currency goes up instead of down, he doesn't take it personally.
Because it's just science.
The market simply provided him with new data that proved his hypothesis incorrect. He accepts the new data, cuts the loss immediately, and formulates a new hypothesis.
That completely changes the temperature of the event.
It neutralizes it.
The difference between a novice and a master is that the novice thinks a loss means they are doing it entirely wrong. The master knows a loss is just part of doing it right.
Exactly. By accepting failure as a data point, you completely neutralize the emotional toxicity of being wrong.
And you can see how all these concepts we've discussed are entirely interlocked. By neutralizing the ego and viewing the loss as just a data point, they are able to deploy that strict risk management, the stop loss, without hesitation.
They don't freeze up. The emotional discipline allows the risk management math to work, and the bespoke strategy gives them the edge to begin with.
I really want to challenge you, the listener, to sit with this concept for a second. Think about how paralyzing the fear of loss is in your own life.
The fear of being wrong.
The fear of a project failing, a relationship ending, a bold career move backfiring. We often stay in losing positions in our lives way too long. We stay in dead-end jobs, we hold on to toxic friendships, we pour money into failing side hustles.
All because we can't stomach the ego hit of admitting we made a mistake.
Exactly. But how liberating would it be to adopt the market wizard mindset, to accept failure as an inevitable part of the game that merely provides an opportunity to learn?
It's a superpower.
To say, this isn't a reflection of my worth, it's just a business expense on the road to my ultimate success. The hypothesis was wrong, cutting the loss, moving forward. It completely takes the teeth out of failure.
It transforms failure from a roadblock into a stepping stone. It is a profound level of psychological maturity.
It really is. But this brings us to a really interesting crossroads. We've talked about the tailored bespoke strategy, the mathematical shield of risk management, the emotional circuit breakers to avoid going on tilt, and the alchemy of turning failure into neutral data.
All the necessary components.
But how do you sustain this over a lifetime? The markets are constantly changing. What worked in 1985 didn't work in 1999, and what worked in 2008 doesn't work today.
Very true.
How do these traders survive across decades?
This brings us to the ultimate synthesis of Schwager's findings. When looking at the long horizon, the interviews point to a powerful dynamic. Success comes from a strong mindset, strict risk control, continuous learning, and adapting to market conditions.
Okay.
However, the traders also emphatically stress that consistency and patience are the ultimate keys to long-term compounding.
Okay, I have to stop you because I am genuinely confused by that. That sounds like a massive flashing paradox.
How so?
You just said they stress consistency and patience. That implies a sort of stubborn steadfastness, doing the same things over and over, waiting for the results.
Right.
But in the exact same breath, you said they must be adapting to market conditions. How can you be relentlessly consistent and patient while simultaneously being highly adaptable and changing with the conditions? It sounds contradictory.
It is a brilliant tension, and you are right to call it out. It is the ultimate paradox of the master trader. How does one remain consistent while constantly adapting?
Yeah. How?
The resolution to this paradox lies in understanding exactly where to apply the consistency and exactly where to apply the adaptability.
Okay, lay that out for me, because if I am trying to be consistent in a market that is crashing, I'm just going to consistently lose money.
Precisely. The consistency isn't in doing the exact same mechanical trade every single day, regardless of what the market is doing.
Okay, so what is it in?
The consistency is in the framework. You are relentlessly, stubbornly consistent in your rules of engagement. You never, ever compromise your risk limits.
Ah, I see.
If your rule is to risk 1% per trade, you do that in a bull market, and you do that in a bear market. You are entirely consistent in your emotional discipline. You step away from the desk when you feel yourself going on tilt every single time.
Right.
You consistently process losses as neutral data points. That internal architecture is immutable.
So the consistency is the mindset and the math of survival.
Yes. However, the tactics you deploy, the specific assets you buy, the timing of your entries, whether you are betting on prices to go up or betting on them to go down, those must be entirely fluid.
Okay, that makes perfect sense.
That is where the adaptability comes in. You adapt your tactics to the market environment because the market is an ever-evolving ecosystem.
I see it now. You are stubborn on the vision and the rules, but incredibly flexible on the details.
Exactly. Let's say we are in a low volatility, steadily rising bull market. A trader adapts to those conditions by buying dips and holding positions for longer periods.
Because it's smooth sailing.
But then a macroeconomic shock hits, volatility explodes, the market starts experiencing massive intraday swings. If the trader tries to be consistent by using the exact same buy and hold tactics from the low volatility environment, they will be shredded.
They'll get wiped out.
They must adapt. They might shorten their time frames, reduce their overall exposure, or shift from equities into commodities. Their tactics change entirely, but, and this is the key, their underlying rule of cutting losses at a predefined point remains perfectly consistent.
That makes so much sense. It's like a professional sports team.
Exactly like that.
The consistency is in how they train, their diet, their commitment to the playbook, their communication on the field. That never changes.
The fundamentals.
Right. But if it suddenly starts pouring rain in the middle of a football game, they don't just keep trying to throw deep passes. They adapt.
They switch up the play.
Yeah, they switch to a running game to secure the ball in the wet conditions. The tactics adapt to the weather, but the discipline of the team remains consistent.
That is exactly how the market wizards operate. They balance unyielding discipline with extreme tactical flexibility. They are continuous learners.
They have to be.
The moment they think they have the market figured out, the market humbles them. So they remain perpetually curious, always updating their models, always testing new hypotheses, always respecting the fact that the market is bigger and smarter than they are.
It is a dynamic, living system. And that really brings us to the culmination of this entire deep dive. When we step back and look at the entirety of Schwager's market wizards, the overarching message is so clear and honestly so deeply empowering.
It really is.
True financial success, the kind that builds empires and withstands the test of decades, isn't about having a magic crystal ball. It's not about being the smartest person in the room with the most complex algorithm or having insider information.
It completely demystifies the concept of the financial genius. It replaces the myth of the innate untouchable prodigy with the reality of the disciplined practitioner.
A practitioner, I like that word.
The traits that forge a market wizard are not bestowed by the gods. They are cultivated through rigorous self-awareness, brutal honesty about one's own flaws, and unyielding discipline.
And to you, the listener, I want to bring this all the way home. We started this deep dive asking what you would learn sitting across the mahogany table from these titans.
And we found our answer.
And what we found is that these traits, managing your downside risk, keeping your emotions in check when the bad beats happen, doing the hard work to figure out a bespoke style that fits your unique personality.
And having the humility to learn from inevitable losses without letting it crush your ego.
Yes, all of that. These are not just tools for managing a billion-dollar hedge fund. This is a masterclass in navigating the uncertainty of life itself. Every single day you are making trades. You're allocating your resources into an uncertain future.
That is a profound way to contextualize it. The principles of the market are simply the principles of human endeavor under pressure, amplified by money.
Absolutely. So I want to leave you with a final thought to ponder long after this audio ends. We've established that the absolute pinnacle of financial success relies almost entirely on mastering one's own psychology, rather than mastering the pure math of the market. So how might applying this exact framework fundamentally change the way you manage the investments of your own life?
That's the real question.
Think about it. What is your stop loss in a heated argument with your partner to ensure you don't say something that causes catastrophic damage to the relationship?
Oh, that's good.
How are you position sizing your time and energy at work so that one failed project doesn't lead to total burnout?
Protecting your psychological capital.
Exactly. If you started managing your daily energy, your time, and your relationships with strict downside protection, acting with unwavering emotional circuit breakers, and viewing your personal failures merely as neutral data points for continuous learning, how much wealthier could your life become? We'll see you next time.